Hi, Brock VandenBerg, fund manager for TaliMar Income Fund I. Well, they did it. The Fed decided to lower the Fed funds rate by 50 basis points. And if you're a lender, you kind of feel like the party is over. But I wouldn't be heading to the coat check just yet because there is plenty of opportunity left in the market for fixed income investors. So the pressing question we are getting right now, how will the Fed deciding to lower the Fed funds rate impact the return of the fund? As always, there isn't a really easy answer to this question. Let me explain. Recently, Chairman Powell and the Federal Reserve decided to lower the federal funds rate. This decision was made in response to several key economic factors, including the need to stimulate economic growth, manage inflationary pressures. By decreasing the Fed funds rate, the Federal Reserve aims to make borrowing cheaper, support consumer spending, and encourage business investment, especially in times when economic growth may be slowing. However, it's important to understand that while changes to the Fed funds rate can influence short-term borrowing costs, our mortgage fund is more directly tied to the 10-year Treasury, which is a more relevant benchmark for long-term investment performance. Let me explain the difference between the two. The federal funds rate is the interest rate at which banks lend to each other overnight. It's a short-term rate set by the Federal Reserve and primarily affects short-term borrowing costs, such as those for credit cards and adjustable rate loans. It's a more immediate impact on liquidity and economic activity, but it doesn't directly influence longer-term assets like real estate lending. The 10-year Treasury yield, on the other hand, is a market-driven rate reflecting investor sentiment on U.S. government bonds over a 10-year period. This yield tends to move with broader economic condition and inflation expectations. And because it reflects long-term risk and reward, it's a better benchmark for investment with a longer horizon, such as a real estate mortgage fund. Since our mortgage fund is focused on longer-term real estate assets, it aligns more closely with the 10-year Treasury yield than the Fed funds rate. As the yield on the 10-year Treasury fluctuates with the broader economy, so does the cost of capital for real estate investment, which influences the returns we offer to our investors. Historically, the average spread between the 10-year Treasury yield and the return of our fund has been approximately 5.2 to 5.5%. This difference represents the premium investors receive by participating in a private mortgage fund, compensating for the additional risk inherent in real estate loans compared to government-backed securities. At the same time, the spread reflects the strong, stable returns that we have consistently delivered to our investors. Let's take a look at the chart.
All right, so I put this table together, and what this table shows is a comparison of three sets of returns. The first here we have is the return of the fund since April 2021, which is essentially when we launched the fund. Here on that orange line, we have the 10-year Treasury. And then this gray line is the Fed funds rate. So in a quick comparison, if you were to look at the two charts here, you're going to notice that the return of the fund here in the blue and the 10-year Treasury return have a much closer correlation than the Fed funds rate that you have here. Now, April 2021, we're about halfway through COVID. You had the Fed funds rate at near zero. This is the first month historical return of the fund. So I'm going to go ahead and just scrap that. This is really kind of when the fund returns started moving forward. So, and where we're at that point at 7.9%. So right here, we were just shy of 1%. So that spread had it larger than what is our normal average spread of 5.2%. Now, what you'll notice that as the Fed funds rate, as we got closer to some of those increases back in March of 2022, you'll notice that that 10-year Treasury yield started to increase and started to narrow that gap between what the return of the fund was and that Fed funds rate. in the 10-year Treasury. So if you were to take an average over the duration or lifespan of the fund, this spread between the return of the fund and the 10-year Treasury on average is about 5.2 to 5.5%. So if you were to fast forward all the way through July, you'll start to see that we did peak investor returns just north of 10% in June of 2024, and you started to see a slight drop in that return, closer to kind of what our median is, which is that 9.5% yield that we're at right now, and our target yield of 9%.
In summary, while the Fed's decision to lower the federal funds rate has an impact on short-term interest rates, it does not directly affect the performance of our fund. Instead, we focus on the 10-year Treasury yield, which better represents the long-term nature of our investment strategy. Our fund has historically provided around 5.2% more in returns than the 10-year Treasury yield, making it an attractive option for those seeking higher returns through real estate lending. If you found this video interesting, please give it a like and subscribe to our channel. We post great content on investing in trust deeds, mortgage funds, and other investments related to short-term real estate loans. Thanks for listening, and remember, don't hesitate to comment if you have your own thoughts on this subject.